the 360 billion naira bond auction earlier held on Monday saw a big drop of up to 1.4% in yields, signaling investor sentiment in the bond market, albeit rising inflation. Egie Akpata, the chairman of Skymark Partners, joins me now to have this discussion virtually. Mr. Akpata, thank you so much for joining us on the show today. What's fueling this big drop we see here in terms of yields compared to the performance of last month's auction and on the back of the recent inflation figure that we just had, 22.8%?
Thank you for having me on the show, David. In terms of the inflation result came out after bids had closed for that bond auction. So the investors probably had little chance to use that. But if anything at all, the very unexpectedly low inflation print relative to expectation will probably have even made bidders more enthusiastic. The primary driver is liquidity in the market. Ever since the central bank has said that they'll have a more equitable CRR regime, they've allowed a lot more naira liquidity linger around in the market, and that has been forcing interest rates down. And most of this money, particularly the money that belongs to banks, has only two places to go: either securities or loans, and they decide to buy government securities.
Okay, and in terms of the pattern we are seeing here now, what is this also telling us? How some insight into the investors' decision-making process at this point in time, for the fact that we have this as a high inflation environment. How much of an insight does this provide into the likely pattern we'll see coming up in the couple of months as we are going further into the second half of the year?
Well, I think the main thing is that you do have some investor classes who are literally trapped into some of these instruments. I mean, banks, you really have two options. You either buy government securities, a few corporate securities here and there, or you make loans. And in the environment where inflation is rising, purchasing power is dropping, it's not a particularly encouraging one to start making loans. So the banks are captive. They have to buy these instruments. Pension funds, somewhat captive. They do have option of going into the equity market, which the banks don't even have an option of doing. So many of these investors who are buying these negative real return instruments don't really have any other choices, and they're just stuck with the environment they're in for now.
Okay, and one of the highlights we saw last week was the redemption of the $500 million Euro bond. We also saw at the I&E window, the Naira closing at about 800 Naira to the US dollar. Let's talk about the correlation between these two events, what it means for the market, and at what point will we see the CBN take some decisive measure in terms of the current Naira value that we're seeing here, and any chance of propping up?
Well, I mean, the Eurobond maturity on July 12th, I mean, it was a 10-year instrument, so it's not as if it suddenly matured. I mean, the government had 10 years to plan for this. And I would assume that $500 million had been set aside a while ago, and so it really doesn't have anything to do with CBN activity today. But again, the good news, though, is that the next Eurobond maturity of 1.1 billion is in November 2025. So there's well over 2 years with no maturities for the government to plan your foreign currency finances properly. The central bank has been intervening in the market, but very, very little, maybe 10 million a week, 20 million a week, tiny amounts that really have no material impact on the trajectory of the exchange rates. And unless they come up with some serious money, at least 100 million plus a week, the trajectory is unlikely to be broken. Parallel market is already at 835, and in an environment where interest rates are dropping and inflation is rising, it's not a surprise that the currency is collateral damage and will continue to weaken from here.
And in terms of forecast now, how much of a dip do you see bond yields going further? And when can we also expect to see more corporates come on board in terms of coming to the bond market at this point in time?
Well, I mean, we somewhat have 2020 as a template to look at. Now, the pandemic, NPR was 11.5, not 18.5 as it is now. A bit of a different environment, but these rates could go down substantially until the central bank determines that they've gone too low. So the direction is probably going to be down on the medium term over the next few months. But at some point, the government is going to have to determine whether lower rates are worth the weaker currency, and the odds are that they'll go for higher interest rates to prop up the currency. But I don't think we're at that point yet.
Oh, okay. So your leaning is also just like roads as well, saying that we might not likely see any sort of improvement in inflation slowdown. Hence, we might just likely have that moderate rate hike levels. Is that it?
No, I'm saying, okay, in terms of the corporates, you asked about corporates.
Yes, yes.
Yeah, corporates would probably start coming to the market around, later this year. Again, everybody likes to bottom fish. And again, when people reference single digit bond yields in 2020, they think that's possible. So most people will delay till around September, October to come to the market. But there will be a lot of issuances because effectively, this is a temporary phenomenon that will eventually reverse probably early next year. So any corporate that wants to come to the market has to do so before the end of this year.
Thank you so much for your time on the show today. It's been a pleasure speaking with you, Mr. Akpata. That was Egie Akpata, the Chairman of Skymark Partners, speaking